And according to our news right here from Times Tabloid, an analyst has asked a question about what would happen if XRP drops to 0.90. Is a shocking drop to 0.90 the secret key to unlocking XRP's multi-dollar future? Have you ever noticed how the most explosive moves in the market always happen right when everyone is ready to give up completely? Think about it. The masses buy when everything is green, but the absolute legends of trading build their empires when the blood is running in the streets and panic is at an all-time high. Right now, as we move through this month of June 2026, a strange vibe is settling over the asset. After entering the month of $1.33, a wave of selling pressure has pushed the asset down, causing a lot of retail traders to look at their screens and sweat. But while the average amateur is panicking, elite market observers are looking at a completely different picture. A prominent crypto analyst right here, Ali Martinez, just shared a chart on X that has sent shockwaves through the community. He didn't promise a straight line to the moon. Instead, he asked a question that turned everyone's head. What would happen if XRP drops all the way down to 0.90? So in this video, we are breaking down why this scary number might actually be the most bullish thing you've ever heard. Right? So let's start with our very first question about why is the 0.90 being called a compelling long-term buying opportunity. When Ali Martinez posted his analysis, a lot of people immediately assumed it was bad news. Dropping below the dollar mark sounds terrifying to anyone who bought near the recent local highs. But if you look closely at the monthly chart shared by the analyst right here, 0.90 isn't just a random number pulled out of thin air. It is the exact convergence of point of an ascending support trend line that has been defending this asset since way back in 2017. This line has been touched during the major macro lows of 2021, 2024, and now. A projected retest seems to be looming right before our eyes in mid-2026. So, my personal opinion is that I look at a drop to a 0.90 not as a disaster, but an absolute gift. In this market, you have to separate your emotions from the structural reality of the macro chart. History shows us that every single time this asset tests its multi-year baseline, it acts as a massive accumulation block for deep-pocketed institutional buyers. If we revisit this level, it clears out all the over-leveraged traders and sets a rock-solid floor. So to me, buying at 0.90 isn't catching a falling knife. It's buying a premier financial asset at a massive structural discount. All right? Now, the next question is, are the multi-year horizontal levels intact despite the recent slide? If you step back and look at the broader macro structure highlighted on this chart, the current price action is just noise inside a massive consolidation pattern. Right? The support is firmly established around the 0.90 zone, but look at what lies above it. The first major macro resistance doesn't even appear. It doesn't even appear until we hit $3.32 right here. Think about the risk to reward ratio on that for a second. If you protect your downside at 90 cents, the runway toward the old highs is wide open. It gets crazier above $3.32. Martinez has mapped out long-term historical extension targets at $8.37 and a staggering $13.57. So, my take on this horizontal layout is simple. The upside potential completely dwarfs the short-term downside risk. We entered June at $1.33, and yes, losing that ground quickly felt unpleasant for the community. But a temporary trip down to test the multi-year baseline keeps the ultimate macro uptrend completely healthy. If the token needs to touch 0.90 to gather enough fuel to smash through the $3.32 brick wall later this year, then as a market observer, I say bring it on. True wealth is built by understanding where the real liquidity sits. Right? Now, why does the February flash crash provide a clue for June 2026? So, to understand exactly how the market might react if we hit this target, we only have to look back a few months. Remember the brutal flash crash we witnessed back in February of this year? The asset took a sudden, violent dive down into the $1.10 region, causing absolute chaos across centralized exchanges. Everyone thought it was over, but what actually happened is that buyers stepped in instantly, absorbing the selling pressure and driving the price right back up because the long-term market structure demanded it. In my opinion, I look at the February flash crash as a textbook example of how fast market sentiment can flip. Right now, people are buying the minor dips, but according to the data shared by the analyst on X, the truly legendary accumulation zone hasn't even been reached yet. If a brief drop to $1.10 caused a massive buying frenzy a few months ago, imagine the absolute wall of institutional buy orders waiting at 0.90. So my perspective is that the market is currently in a wait and see phase, and a final rapid flush down to 90 cents would act like an electric shock, waking up the bulls for the next macro expansion. Alright? Now, can a successful defense of this baseline set up a multi-dollar breakout? The most critical takeaway from the chart posted right here on X is that as long as the asset stays above this ascending support line right here, this one, the multi-year bull market structure is completely valid. It hasn't broken, it hasn't shifted, it's simply testing the foundation. A successful defense of this area means that the lows are consistently getting higher over a 5 to 9 year horizon. When an asset compresses against flat resistance at $3.32 right here, while building higher lows from 0.90, basic technical law tells us that the eventual breakout will be historic. So in my view, the absolute obsession with daily price movements causes most retail traders to miss the forest for the trees. If you are constantly staring at the 5-minute chart, a drop to 90 cents look like the end of the world. But if you look at it from a macro perspective, it's just the final puzzle piece fitting into place before a massive structural breakout. So as a market observer, my strategy is clear. Don't get shaken out by the noise. Keep your eye on the baseline and remember that real market expansions require deep structural retest. Alright? So, my overall conclusion about this is that the recent price decline from $1.33 down toward our current levels has put the market on high alert. as we watch the 2026 lows get tested. The chart shared here by analyst Ali Martinez gives us a definitive roadmap for what to expect if the selling pressure intensifies. Rather than viewing a potential drop to 0.90 as a failure of the asset, the macro data suggests it is the ultimate long-term buying structure, aligning perfectly with a multi-year ascending trendline that has survived every market cycle since 2017. So my personal observation of this entire setup tells me that we are approaching a defining moment for the ecosystem. The horizontal resistance levels up to $13.57 remain completely achievable over a longer time horizon, provided the bulls successfully defended the structural floor. While the short-term sentiment might feel heavy right now, grounding your expectations in macro data rather than temporary market panic is what separates successful market participants from those who get left behind. Watch the 90-cent zone closely in the weeks ahead. It could very well be the launch pod we've been waiting for. All right? And this finally ends our video. Thank you very much for watching, and see you on the next one, or you might just as well check this recommended video right here on the screen.